In the vast expanse of the business universe, countless companies twinkle like stars, each with its unique story to tell. Some shine brightly, their value evident to all. Just as astronomers use telescopes to study celestial objects, investors and analysts employ various tools and techniques to evaluate companies. This quest for understanding is known as company valuation, a process as intricate and fascinating as charting the cosmos. By unraveling the mysteries of a company's financial performance, growth prospects, and market position, we gain insights into its true value. In this exploration of business valuation, we will embark on a journey to unravel these complexities, equipping ourselves with the knowledge to navigate the intricate world of finance. At the heart of every company lies equity, the very essence of ownership. Imagine a company as a grand cosmic tapestry, woven together with threads of investment. Each thread represents a share of ownership, and these shares collectively form the company's equity. When individuals or institutions invest in a company, they are essentially purchasing a portion of its equity. This ownership stake entitles them to a share of the company's profits, as well as a voice in its governance. Common stock grants shareholders voting rights and the potential for dividends. Preferred stock typically does not offer voting rights but often pays a fixed dividend. By analyzing a company's equity structure, investors can gain insights into its ownership, risk profile, and potential for growth. Imagine a cosmic snapshot capturing a company's financial position at a single point in time. This snapshot is known as the balance sheet, a fundamental financial statement that provides a glimpse into a company's assets, liabilities, and equity. On one side of the balance sheet, we find a company's assets, its valuable possessions that fuel its operations and generate revenue. These assets can range from tangible items like buildings, machinery, and inventory, to intangible assets like patents and goodwill. On the other side of the balance sheet, we encounter a company's liabilities, its obligations and debts. The balance sheet equation dictates that a company's assets must equal its liabilities plus equity. By carefully examining a company's balance sheet, we gain insights into its financial health and its ability to meet its obligations. The income statement, also known as the profit and loss statement, unveils a company's financial performance over a period of time. At the top of the income statement, we find a company's revenues, the lifeblood of its operations. From there, the income statement outlines the costs incurred in generating those revenues, known as expenses. Expenses can be categorized as either cost of goods sold, COGS, or operating expenses. The difference between a company's revenues and expenses is its profit, the ultimate measure of its financial success. Profit can be further categorized as gross profit, operating profit, and net income. By analyzing a company's income statement, investors can track its revenue growth, assess its cost management, and evaluate its profitability over time. This analysis provides valuable insights into a company's operating efficiency and overall financial health. Cash flow reigns supreme, the lifeblood that sustains a company's operations and fuels its growth. The cash flow statement tracks the actual movement of cash both into and out of the company. Cash flows through a company in three primary currents: operating activities, investing activities, and financing activities. Operating activities encompass the cash flows generated from a company's core business operations. Investing activities involve the purchase and sale of long-term assets. Financing activities involve transactions with investors and creditors, such as issuing stock or taking on debt. Understanding a company's cash flow is paramount to assessing its financial health and sustainability. A company with strong cash flow from its operations is generally in a better position to weather economic storms and invest in its growth. Market capitalization emerges as a cosmic yardstick, measuring the perceived worth of a company in the eyes of investors. Market capitalization is calculated by multiplying a company's share price by its total number of outstanding shares. This metric provides a snapshot of a company's overall value in the marketplace. Market capitalization serves as a useful tool for comparing the relative size and value of different companies. It provides a common denominator for assessing the market's perception of a company's growth prospects and profitability. However, it's crucial to remember that market capitalization is just one piece of the valuation puzzle. It's essential to consider market capitalization in conjunction with other valuation metrics to gain a comprehensive understanding of a company's true worth. The price-to-earnings ratio, or PE ratio, allows investors to compare the valuations of different companies relative to their earnings. The PE ratio is calculated by dividing a company's current share price by its earnings per share, or EPS. EPS represents the portion of a company's profit allocated to each outstanding share of common stock. A higher PE ratio suggests that investors are willing to pay a premium for the company's earnings. The PE ratio is a powerful tool for comparing the valuations of companies within the same industry or across different sectors. It helps investors identify companies that may be overvalued or undervalued relative to their earnings potential. However, it's important to note that the PE ratio is not a one-size-fits-all valuation metric. It's essential to consider the PE ratio in conjunction with other valuation metrics to gain a holistic understanding of a company's investment potential. Beyond the realm of balance sheets and income statements lies a universe of intangible value. Brand equity, the intangible aura surrounding a company's name, logo, and reputation, holds immense power in the marketplace. A strong brand can command premium prices, foster customer loyalty, and attract top talent. Intellectual property encompasses patents, trademarks, copyrights, and trade secrets, granting companies exclusive rights to their innovations. Human capital, the collective knowledge, skills, and experience of a company's workforce, represents another crucial aspect of intangible value. A talented and motivated workforce can drive innovation and enhance productivity. While intangible assets may not appear on a company's balance sheet, their impact on a company's value can be substantial. Savvy investors recognize the importance of these intangible factors, incorporating them into their valuation analysis. Competitive advantage emerges as a guiding star, illuminating the path to sustainable success. Companies that possess a durable competitive advantage have a unique edge over their rivals. Competitive advantage can manifest itself in a multitude of ways. Some companies leverage their vast scale and operational efficiency to offer unbeatable prices. Others differentiate themselves through product innovation and design. Identifying a company's sources of competitive advantage is crucial for investors seeking to assess its long-term viability and growth potential. By carefully studying a company's competitive position, investors can gain valuable insights into its ability to maintain its market share and generate sustainable profits. Growth potential shines like a distant galaxy, beckoning investors with the promise of exponential returns. Companies with strong growth prospects are like stars on the rise, their luminosity increasing as they expand into new markets. Assessing a company's growth potential requires analyzing its industry trends, evaluating its management team, and scrutinizing its track record of innovation. Companies operating in rapidly growing markets often have a greater potential for growth. Innovation is the lifeblood of growth, and companies that consistently invest in research and development are more likely to outperform their peers. Analyzing a company's growth potential provides insights into its future earnings power and its ability to generate shareholder value. Companies with a history of strong growth and a clear vision for the future are more likely to continue on an upward trajectory. As we conclude our exploration of company valuation, we emerge with a deeper appreciation for the intricate interplay of financial metrics, qualitative factors, and market forces. Investors rely on a constellation of tools and techniques to navigate the business cosmos. We've journeyed through the fundamental financial statements, uncovering the secrets hidden within balance sheets, income statements, and cash flow statements. We've explored valuation metrics like market capitalization and the price-to-earnings ratio. Moreover, we've ventured beyond the realm of numbers, recognizing the importance of intangible factors like brand equity and human capital. Finally, we've gazed into the future, contemplating the power of growth potential and the factors that contribute to a company's long-term success. By mastering the tools and techniques of valuation, we empower ourselves to navigate the complexities of the business world, making informed decisions and unlocking the secrets of successful investing.